Hello, chart watchers, and welcome to this Tuesday, November 6th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got the Dow Jones Industrial Average trying to break to a fresh new high here over the past couple of weeks. It is up another 105 points currently this morning. The S&P 500 up 8.5. The NASDAQ is up about 30, still trying to negotiate its recent highs. Same thing goes for the Russell 2000, which currently is up 2 points today. 10-year Treasury yield, not a whole lot going on in terms of economic reports, but the 10-year Treasury yield is up a basis point, 3.21%. Volatility hanging out right around that 20 level. Materials leading to the upside today, really trying to break out of a bottoming head and shoulder pattern here. Pretty bullish action so far today on the materials. Industrials also strengthening, getting up into this gap resistance zone, testing its 50-day moving average in the process. Mosaic leading specialty chemicals higher on a strong earnings report. We'll talk about that in a bit, but you can see Mosaic up more than 7% today. To the downside, energy. We had been seeing a nice little bounce out of energy, but it is lower today. It is the worst performing sector. At last check, it was the only sector that was down today. Financials also weak, but they are up at least fractionally so far today, trying to continue their recent winning streak. And to the negative side, from an individual stock standpoint, Marriott reported its earnings, and you can see down almost 7% today. One of the worst performers in the S&P 500. All right, Erin, it is Election Day 2018. How's your morning going?
It's going well. I'm preparing my sample ballot so I can go and get my I voted sticker down the road. So I hope you voted, and everybody else out there, if you haven't, I would suggest you do. This is probably going to be a record breaker, Tom, from what I understand.
Yeah, at least for a non-presidential election. That's what I've heard, at least based on the those who have sent in their ballots early, which I've done. Mm-hmm. So, yeah, I mean, I think that this will be an interesting election for a lot of different reasons. But and I think, you know, the market, I think it was Arthur Hill that wrote in one of his blogs recently about the overall election and how to trade it. And he said, the problem is, number one, you don't know the election results. So you got to get that part right. And then you know the market reaction. You might think you might know the market reaction to a specific result, but you really don't. So you really have to sit back, kind of watch and see what the market's telling us. And that's what we'll be doing here over not just today, but over the next few days here.
Absolutely.
All right, what's on tap for today?
All right. Well, let's see the upcoming schedule for the week. We do have Brian Livingston. He is a new blogger here at StockCharts.com, Muscular Portfolios. So that'll be great. Grayson Rose will join us on Thursday, and Friday, Mary Ellen will be back for What's Hot and What's Not. Today's agenda, first thing up, well, it's not Dr. Elder. It'll be me. I'm sorry. I've got a workshop today, no problem, about trend and condition analysis. 10 and 10, our first symbol is going to be Ryder System Incorporated Systems. Sector rotation will finish off the program. Tom's going to go over some interesting results and what's going on with our sector rotation tables. But let's go ahead and get started, Tom. What kind of technical news is out there?
All right, nothing in terms of economic news, at least nothing very big. And the 10-year Treasury yield just kind of flat, sitting close to the high we saw from a couple of days ago. This was last Friday. It was a big move in the 10-year Treasury yield. Of course, that came after a better than expected non-farm payrolls report. We pulled back a little bit yesterday. Now we're back up near this level. We're not too far from breaking out above that 3.25% area. And that spooked the market back in October, but I still believe higher interest rates, as long as we don't go shooting higher, I think they're not necessarily a bad thing. I think it's a reflection of the bond market believing that the economy is strengthening, and that, I believe, is a good thing for corporate America and for the S&P 500. So we'll continue to watch that, but don't be surprised. I do believe we are going to break out in time, but for now, we are just simply consolidating here. All right, on the earnings front, even though there were no economic reports, there are still plenty of earnings reports coming in, and you can see a list of them right there on your screen. Booking Holdings did miss on the bottom line, but they raised their guidance. They beat on the top line and raised their guidance for both revenues and earnings going forward. So we'll talk about that in just a bit. But as you go down the rest of the list there, you'll see some beats. Occidental Petroleum, Marriott, Eli Lilly, CVS Health, and Becton Dickinson all came in better than expected. So let's take a look at what some of these charts look like, because you know, the way they report isn't always the way that they react. And you can see booking did try to break out above this 2,000 level, big gap up with that raised guidance, but you can see it has been selling off since the open and off of this uptrend. Currently, it's got this black candle, and that normally suggests some pullback in the days and weeks, maybe weeks, who knows, but days ahead, I would say. If you look back here to the July candle, you can see an uptrend, the big gap up there, the failure with the black candle, and back down we came off of this uptrend. Here's that black candle at resistance and at this gap resistance, not just the price resistance from early October, but also trying to negotiate this gap resistance. We had gapped down back in August on very, very heavy volume on booking. And so getting back up and through that gap resistance level is going to be the first key area of resistance, and the first level the bulls are going to be trying to negotiate. So far today, I would say epic failure. Occidental Petroleum, OXY. If we take a look there, they came up short. No, they beat on the bottom line. They also beat on the top line. I was thinking they came up short on their revenues, but they too are printing this black candle. Now, in this case, we are coming back down, testing the 20-day moving average and trying to bounce off of it. So I'm going to wait a little bit to judge the chart here on OXY. But if we do finish with this black candle, and especially if we go back down and close below the 20-day moving average, I would think in the short term, we've probably made the run. Another thing, look at the heavy volume gap down back on October 15th. We opened at 75, traded all the way down into the 65s. And now today, after the gap up, you can see that tail going right up to $75 and reversing. So I think the line in the sand here for the bears, breakout above 75, I think would be bullish. So you want to be careful if you're on the bearish side if that happens. And to the downside, the bulls are looking at those recent lows and maybe in the short term, that 20-day moving average. So those are a couple areas to watch. Marriott did miss on their top line, beat on the bottom line, but then they lowered their fourth quarter EPS guidance. And, of course, that's what the market prices everything based on, is the future, not what you just did in the last quarter, but what you're going to do in the next couple of quarters. So normally when you lower your guidance, you're going to get hit to the downside, and that's what's happening so far with Marriott. I would say, again, the recent high up around 122.50 is the resistance I would watch. To the downside, I wouldn't be surprised to see us make a run down for 107, 107.50 to test that October low. Eli Lilly, of course, in the pharma space, they beat on the top line, beat on the bottom line, raised their guidance, and this will go to show you it doesn't always matter what you come out with on your news. Eli Lilly did go back and test support around 105. I actually think, given the report that they came out with, this pullback to 105 could represent a pretty nice low-risk opportunity to enter the stock. Close below 105, and I would be much more careful. Volume trends have been pretty good. This has been a strong area of the market. The report, like I said, not bad, beating on top line, beating on bottom line, raising guidance. But nonetheless, the stock did pull back and is now closer to a short-term price support area. CVS beat on the top line, beat on the bottom line, reaffirmed their guidance, and the market likes it. We are moving back up, not just through the 50-day moving average, which is good, but also into this gap resistance zone. I would say the 78 and a quarter level is going to be big. We've gotten through the bottom of gap resistance. Now I think we're going to make a run for the top of gap resistance. So maybe another 1 to 2%. I would say 2%. Then I'd be a little bit more careful as we get close to that gap resistance area. Becton Dickinson, BDX. They beat top line, beat bottom line, but they lowered their fiscal year 19 revenue and EPS guidance. Stock got gapped down, went all the way back down, tested the support level, and now has rallied back up. So a lot of indecision, although there has been mostly buying since that opening gap lower on Becton Dickinson. A few other earnings reports I thought were interesting that actually we saw some pretty good results and responses to. One is Fabrinet, FN. Here's a stock that beat on the top line, $377 million versus $352 million expected. So pretty significant beat on the top line. Bottom line, 92 cents versus 81, and they raised their Q2 guidance. You can see the volume picked up, gapped up, traded a lot higher earlier, has come all the way back down. I think if it continues to move back down, given the numbers here and that initial reaction, I think anything back down near 46, if we were to continue dropping, maybe not today, but maybe over the next few days, I think as you get down close to gap support, price support, and that rising 20-day moving average, this is one I'd keep on my radar. Mosaic, I mentioned this one at the top of the show. They did come up a little short on their revenues, $2.93 billion versus $2.94, but they beat on the bottom line, 75 cents versus 65 cents, and they raised their fiscal year guidance, earnings guidance. Gapped up above resistance, continuing to trade higher. Really strong volume here on Mosaic. Zebra Technologies, ZBRA, they beat top line, beat bottom line, raised Q4 guidance, gapped up. This is one that went all the way back down to that gap support area, now trying to turn back around. I think this is one that goes higher in time, but gap support and the rising 20-day is where I would look for possible support. On Deck Capital, ONDK, beat on the top line, 103 million versus 98.3. Beat on the bottom line, 17 cents versus 11 cents. They raised their fiscal year 18 revenue guidance. Market loving this report. After the stock had gapped up with a great report in August, we worked our way all the way back down to gap support. Now we come out with another solid report. Looks like it's heading back to test that 9.25 area. Haymanetics. This is one I mentioned in ChartWatcher's article over the weekend. This is a company that had beaten its earnings, revenue and earnings estimates the last 4 quarters, had great responses. They did it again. They beat on the top line, 241.6 million versus 233.4. They beat on the bottom line, 56 cents versus 54 cents, and they raised their fiscal year 19 revenue guidance. Stock trying to get back through the 50-day moving average. I think this 110, 111 area is going to be difficult to negotiate, but if it does go through, I think eventually we're going to get back up to 117.50. What I'm looking for here actually is off of this uptrend, pull back left, inverse left shoulder, neckline, inverse head. This could be a move up to that 111 area to put in the right side of a neckline. I think anything back down around 105. We saw that earlier today. I think a 105 print would be a nice reward to risk entry into the stock. RNG, this is a software stock. They beat by about 4% on their revenues, better than expected. Beat on the bottom line, raised guidance, stock gapped up. But look at this move down below yesterday's low, still holding this gap support from about a week ago. The big problem with this stock is not so much their results. I think it's the software group in general. As we pull up the software index, you can see, look at all these failures over the 20-day moving average. We had this nice move up. Can't seem to get that breakout, though. Keep trading below the 20-day. I think it's going to be tough for a lot of these software stocks unless we can make this breakout. If we start to roll back over, going to have to be real careful with many of these software stocks in the days ahead. All right, we had some upgrades, downgrades. Let me try to go through those for you fairly quickly. Let's see. Here we go. First one I want to show you is Allegheny Technology, ATI. They were raised from a neutral to a buy. You can see we've been going sideways here for a while. I think support and resistance clearly established. Resistance up close to $30. Support on this big drop down here in recovery. Looks like 23 would be your area of support. I'm going to stretch this chart out. Let's take a look at it over a year. I think this shows that other support, that other low down here around this 22.5, 23 area. Also shows another high up around 30. So Allegheny just simply in this sideways consolidation mode throughout 2018. I don't think there's anything to do. And in fact, off of this uptrend, if we print this black candle right here, I would suspect the next few days we'll probably see some action to the downside. So I would not be chasing on this upgrade. Next up is Milan Labs, raised from a neutral to a buy. I believe Milan also reported earnings. I don't recall what they did. I think they either missed one or the other, top line or bottom line, and beat on the other one. I think it was a mixed report, but they did get the upgrade, and I think they may have raised guidance, but I'd have to go back and double check that. Here you can see the stock moving up. Let's see how Milan finishes today. This could be a really important close because if you notice, we had a big double bottom breakdown. Here's that double bottom. Here was the move lower with increasing volume. So if we leave a tail up above that 50-day moving average, come back down and close near the low of the day, that to me would be a short-term warning sign here on Milan. But if we continue to strengthen with this kind of volume and we break above the resistance, then I think it would be bullish. So let's see how we close today on Milan. Next up, ShakeCheck. ShakeCheck did get upgraded from neutral to buy. And let's take a look and see what that chart looks like. Well, we're moving up, but notice we just broke down on heavy volume. It looks to me like maybe we're going to go back up and challenge this area of resistance. I like the space, and ShakeCheck had outperformed for a while. It's underperforming now, but I would be looking for possibly a reversal in this area. And the reason being, you've got great gap support right here from early May, which also lines up with a prior high. So now as you come back down, this could be more than just a little bounce. This could be a major area of support where we begin to strengthen again on SHAK. I do like the space, and I think that will help ShakeCheck trying to shake off some of the negative action we've seen of late. Square upgraded, also from a neutral to a buy. And to pull this one up, trying to get through the 20-day and hold. I think the key is going to be this reaction high around $80. 2 days ago, back on Friday, we hit 80 on an intraday basis, couldn't get through, went all the way back down to 72. You can see the volatility is pretty significant here in Square. I think there's a lot of indecision between buyers and sellers. So do we break back down below the low yesterday, or do we break back up above 80? I would be watching to see which one of these levels goes first. Downgrades. AU, Anglo Gold, lowered from neutral to a sell. The problem I have here with this stock is it broke out with a negative divergence, and on this downgrade, it is failing to hold the breakout. So that, to me, tells me unless we get a big reversal later today, I would expect some more selling. And when I see negative divergences, I start thinking PPO to the center line, price action down to the 50-day. So I think this gap support area down closer to $9 could come into play here on AU. I would wait, see if we get it down that low. SPLK, SPLK, lowered from outperform to market perform. This, I believe, is also in that software space. We can pull up the relative chart and see it is a software stock. And this is one of the big problems. Just software has been under so much pressure of late. I will say this, though, that SPLK, even though software could not get back to its reaction high from mid-October, SPLK did. So we were beginning to see some relative strength in the stock relative to its peers until today's downgrade. Now I would say we just simply are trading in a range between the low that was established in late October and this double top now, which is about 106. I think it's in the middle of that range. I don't think there's really anything to do here with SPLK on this downgrade. I don't see it as much of a trade. And then the last one I have here is Western Union, WU. This was lowered from an outperform to a market perform. You can see that the group overall had been performing pretty well into late September, but Western Union was not. And when you look at that on a relative basis, this is one of the weaker stocks within this space. And so shouldn't be shocked when we get a downgrade. Now, the stock is trying to make a push to the upside, maybe just an oversold bounce. I think there's a couple levels. Number one, if we can clear 1850 on a closing basis today, short term, that would be bullish. But I'd keep a pretty tight stop, probably at that 50-day moving average, because you do have a downtrending stock and you've got one of the worst stocks within the space. So that makes me a little nervous. If I'm going to play a breakout, I want to make sure I keep my stop really tight. Now, if we do get this breakout, I think clearly the major resistance level is just north of 19.25. So that would be another 70 cents, roughly another 4% or so to the upside until we reach that level. If I was in it, I'd be taking profits, certainly at that 19.25 area, and let's see if we can get the stock to break above. Okay, Erin, I know everyone's patiently awaiting your workshop, so I'm going to turn it over to you. Take it away.
All right, let's get it started. Let's see here. grab the screen. All righty. Better. Let's see. Is that good? You're seeing the right thing?
Yes, you're good.
Excellent. All right, so let's get started. Okay, so today I'm going to do a workshop on DecisionPoint trend and condition analysis. And, you know, the last workshop I did 2 weeks ago was on big picture indicators. And this time around, rather than starting with the indicator and then looking at it across the various indexes, we're going to go the other direction. We're going to start with an index and then move through all the different indicators for that index. And that's the beauty of our DecisionPoint ChartPacks. They are set up so that you can choose which direction you want to go. Am I really interested in, say, the McClellan oscillator across what it's doing across all the different indexes? Or am I interested in what's going on with the NASDAQ 100? And I want to see all of the indicator charts for the NASDAQ 100. So that's the direction we're going to go today. So trend and condition analysis, and I'm actually putting the finishing touches on an article that will go into Chart School about a little bit more detailed about trend and condition analysis. But these are the basics, you know, as far as decision point analysis. And if you've watched any of the ChartCom presentations or any of my workshops where I've talked about, you know, our different analysis processes, this should be very, very familiar. So the first thing what we do is we like to look at what's going on with the trend. And when I talk about the trend, we're talking about price trend, looking at the daily, weekly, and monthly charts. So all we're really looking at in the trend part of our analysis is what's happening with, you know, rising trends, falling trends, you know, declining tops, trend lines, support and resistance. It's all about the price. Once you've gotten your look on the price, then you want to go and analyze your current market in conditions. And the conditions of either just the index, you can find using, you know, your PMO and the momentum and volume, or like I said, when we're looking at these big picture indicators, since we're going to study more so an index versus a stock, we'll be looking at the big picture indicators to analyze our current market conditions. And then also in our trend and condition analysis chart pack, we also have studies of the dollar, gold, oil, and bonds in there. So I'll be going over that as well. So not only will I kind of go through our analysis process, I'm going to show you how I do that using our DecisionPoint chart packs. So it's great if you are an extra member or above. Very easy to download these chart packs. And I'm going to go ahead and show you how to do that first, because I'm going to be using these chart packs to give you examples of how I do my trend and condition analysis. So let's go over there first. All right, so here we are on our handy dandy members dashboard. And what we want to do, remember, we're now downloading a DecisionPoint chart pack. So the way you get to your chart packs is you go up to your account right here, and you go ahead and click on that. And it's going to bring up all your information. And then if you look right down here, chart packs. Currently, I only have the DecisionPoint market indicators. And the reason I have that is because I went over that 2 weeks ago in the big picture indicators workshop. So I click on Manage Chart Packs, and here we are. You can see I already have this one. And what I want to do today is I'm going to install both the Straight Shots chart pack as well as the Trend and Condition chart pack, because they both kind of work hand in hand. I like the Trend and Condition chart pack because it does bring in, you know, gold and the dollar. That's within that chart pack, whereas Straight Shots tend to be are just really what the indexes are, maybe a sector, and then looking at within that the indicators. So we also have an intraday chart pack, which is very handy. I can show that to you another day. But basically, if you download this, I'll just give you a click here so you can see. It's really handy for just getting that quick look at what's going on in the markets. It's just 10-minute bar charts, and they are across well, there's 50 of them. So the beauty of the intraday chart pack is that you can go and click, 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 click all the way through these, or you can look at it in Candle Glance and just have all of the major indexes on there for, intraday looks. So you can just, keep an eye on it as we go, but we're not going to do that one. We want to download the straight shots and the trend and condition. So let's go ahead and do that. And they are free. And here are what is included in them. So this is the straight shots one. So you can see it's just indexes, the major indexes that we cover. And each of these has all of the indicators, the big picture indicators for each of them within their own little chart list. So I'm going to install that chart pack first. And again, free, very easy. So now if I go down here to my chart lists, there are my market indicators. But if I keep going down, now I have the straight shots chart pack, and it's right in here just like we saw it for installing it. All right, so we still need to install the trend and condition one. So let's go ahead and do that. There we go. And like I said, I'm showing this to you just because it makes it easier to give you an example of how to use our trend and condition analysis, because these are ready-made. You can just use them right away. So the trend and condition charts, as you can see, includes the gold, silver, the XAU. We have bond price and yield and TLT, the 20-year bond. So this covers more of your commodities. It has a little bit more involved in it than just the major indexes, which right here you can see these top four. Those are the DecisionPoint scoreboard indexes that I keep track of for you on the home page. If you get your DP signals tile, that's what those four are the ones that we cover. And so that works out well to look at it in the trend and condition chart pack. You can do it that way, or like I said, we'll look at some of the straight shots, which is really the same sort of analysis process we're talking about today. All right, so now we know how to install the chart packs. Now let's actually get into using them a little bit. All right, so we're going to come back to this. I want to come back to this. I will. Okay. All right, so we just looked at how to download a DecisionPoint chart pack. Remember, you just go to the Your account from the home page, Manage Chart Packs, and then that's where you can install them as well as remove them. I think you saw the red button there. So, try them out. It's no big deal. Try them out. You can annotate whatever you want to do, and then remove them if you just find it's not very helpful. But I'd be surprised if you didn't find them helpful. I find them very helpful, but they are easy to install and remove. Just so you know, if you reinstall or you remove them and then install, if you had any annotations or anything within those chart lists, those disappear. So when you reinstall, it's going to be fresh. You won't have any of your annotations. So just be aware of that if you decide to remove it and then put it back. All right, so let's get back to the analysis side of things. So here is the first step of the trend and condition analysis. And that is, and this works for anything, ETFs, stocks, whatever it is, as well as indexes. This is what I do to start looking at trend and condition. So the price trends, obviously, you can get that using the trend model signals, and I'll show you how to do that. That'll give you an idea of what's going on with the price. And then also on my daily charts in particular, I also include momentum indicators. This gives us an idea of the condition of what's going on within that stock, ETF, or index. Looking at the volume patterns, I use the OBV, relative and internal strength. You can do that using the scooter or even comparing PMO values from one index to another. It will show you relatively how much stronger or weak it is in comparison. So I find the scooter to be especially helpful with that, but you can also do that with the PMO. So that's how you do your trend and condition for just a stock, ETF, or even an index. But if I'm looking at an index or a big picture sort of indicator, that's the conditions analysis that we need to do, is the market condition analysis. So we were looking at price trends, right? Price trend trends on our daily charts or weekly or monthly. And we looked at the individual indicators for that particular stock, ETF, or index. This is for when you're looking at an index. These are the indicators that are considered market indicators, or I like to call them big picture indicators, because they give you a view across that market or that index, what is going on. For example, the percentage of stocks above their 20, 50, 200-day EMAs. That's a big picture indicator that tells me about what's going on within that index. How many are, doing well, how many are not doing well, just based on that percentage in those 3 time frames. And like I said, I did go over a lot of that in my previous workshop on big picture indicators. And you can find that, you can find it on YouTube. So once you've got your big picture indicators, in the case of when we were looking, if we look at gold, bonds, or the dollar, you'll see when we go into those chart lists that it also has corresponding markets and things you might be wanting to look at as far as the trend and condition of gold per se, or silver. And we'll look at that, like I said, shortly. And then special studies is a way to analyze market condition. And if you've if you have watched Market Watchers Live on Fridays, you know that I do a sentiment report, sentiment update, and that would be, I would consider, a special study to see what else is going on in the market. So if you want to go kind of off to the side, a lot of these indicators are also included in these chart packs. So, all right, so let's go ahead and do some real time here, trend and condition analysis. So hold on just a moment, we'll get right there. All righty. Okay, so now we have these chart packs in here. And like I said, what we're going to do today is, instead of looking at, as you can see in their market indicators chart pack, instead of looking at an indicator and then looking at, for example, so instead of picking, for example, the McClellan oscillator and then looking at it across the various indexes, what we're going to do is we're going to go the opposite direction. We're going to start with an index and then move through all the indicators for that index. So you can see sometimes, depending on what you're interested in looking at, that determines which chart pack you'll probably want to look at. I'm going to go ahead and we'll start with the trend and condition chart pack, because it does include some of these things that we don't necessarily include all the time, like in our DP chart list, the DP chart gallery. A lot of these aren't in there, so I wanted to go over those first. So this is the trend and condition chart pack. And let's go ahead and we'll start looking at a few of these various chart lists. So we'll start with the gold one. And I will tell you that the gold one is very similar to the GLD one, only of course this is giving us the spot price. And what we do is we already have it set up in the various time frames. And so that'll give you a good look at what's going on, as far as price trend all the way across. And then we also track the Sprott Physical Gold Trust. That's where we get our discount premium information. It's a closed-end fund, so like Central Fund of Canada, they have a specific amount of metals, and then depending on what people pay for that, whatever price they get in there and pay for it, that could mean that it's at either a discount of what the actual value is of what they're holding, or it could be a premium for what the actual price of what they have is at that point. So that's how we do our discounts and premiums. So let's go ahead and we'll just walk our way through one of these. So here we go. So as you can see, here's your first one, your daily chart. Remember, this is dollar gold, so we're going to have, we will not have the action from what's going on currently today. But let me make this a little bigger for us. All right. And again, you can now use the arrows to kind of go through and see what's going on. So here's the 1-year chart for gold, gives you an idea of what's going on. And again, this is the daily chart. So what I've noticed and what I've talked to you about in the DecisionPoint reports on my DP alerts on Wednesday, as far as gold is concerned, we've got that bottom above the signal line. That tells me that that's bullish as far as momentum goes for the PMO. I think it's especially bullish usually when you see a bottom above the signal line. And as you can see, it's not at all what I would call overbought. We could still certainly see the PMO move higher. My issue right now, I'm just giving you a little free analysis here. My opinion right now is we're not seeing the kind of action that we should off of a move like this on the PMO, and that has me a bit concerned. Although at the same time, it's showing that maybe internally there is some momentum and it's ready to break. It's ready to, like a rubber band. It's time for it to now move. It's had all this momentum in the background underneath the surface, and now we could see the pop. But my concern at this point is this rounded top right now on gold. I think that could be a problem, and it just hasn't been working the way it should. When you think about it, we should have had a breakout of more serious proportions. I would have expected a much better breakout. You can see right now, when you look at, again, this is in our trending condition chart pack, you can see the PMO is on a buy signal on the weekly chart. So that gives us an intermediate term trend model buy signal. And we can still click on through. Now we're looking at a monthly 20-year for gold. Click on through, and here's that Sprott Physical Gold Trust. And here's the information that I follow most closely is that premium discount. Right now, you can see discounts are moving higher. That means that sentiment is bearish right now for gold. And when you see bearish sentiment being contrarian, you should expect a bullish move from that. Now, of course, I'm looking at the PMO for the Sprott Physical Gold Trust, and it is now in decline. I'm going to add a thumbnail here just because I want to see exactly what's going on with that. And there we go. Yes. So you can see at this point with the Sprott Physical Gold Trust, the PMO is not really turned up. It's in fact pointing downward and looking toward a sell signal. So I think that also gives us some, again, an idea of what's going on within this particular chart list of all of the gold information. And then here is the CEF. Right now, it's really it's a gold and silver trust. I don't think we're following this one as much anymore, but it still gives you sort of the same information that we want to look for as far as the premiums and discounts. But I find that this one is a lot more handy as far as that. And this is an 8-year chart. All right. I apologize that there's a lot of white space here, but these are how those chart packs are downloaded. So you'll just have to bear with me there. All right. So more in the trending condition chart pack. Like I said, I'm going to skip the top 4 because those are covered very well in the straight shots chart pack. Silver. This will give you an idea of what's in our silver one. You can see we have all of the different the price charts up through 20 years, and then also the CEF, which Central Fund of Canada also includes silver. Bond yields. Again, this all gives you trend and condition for each of these areas. So in the case of the 30-year Treasury bond yield, of course, we have, it's pre-done with the PMO, and we have all of the different time periods already there for you. Let's look at, here's UUP, the dollar, which is what I follow very closely in the DP alert. Again, you have all of the different time frames already produced for you. This is some of the other markets you might be interested in are also included in here. So you have the euro is in here. And we also have the Japanese yen. And of course, you could add more in there. for what you would like, but these were the ones that we have ready-made and prepared for you. All right, and the commodities, well, we'll go ahead and look at the oil ETF chart list. And again, it's all of the different time frames already ready for you. And then we also have the oil volatility index. I don't know if you knew that that was a thing, but we do have that. And as you can see, we're getting volatilities going to the upside. We're getting a lot of volatility. We're reading right now at 33.87. This is, to me, you know, we have to, I think it's a good thing the more we get high on the on this. A lot of times with the volatility index, you know, when you get people very nervous and very bearish across the board, that's usually when you're going to see a price reversal. So these volatility indexes, I think, are very helpful for that. Boy, we can see today USO, though, down here right now, testing very important support here at $13. We'll have to see if that can hold. All right, so I think I've given you a pretty good idea of what's in the trend and condition chart pack. And there you go, commodities, same idea. And, you know, when we had our DecisionPoint site, all of these charts and lists were all on our homepage. I don't know if any of you are previous subscribers, but we had all of these charts with links on the homepage. So our homepage was just, we used to completely freak a lot of people out when they got to the site, because we just had so many charts, and the links were right on that homepage. These are straight from the website, and that's why we have, you know, already pre-made those different time frames in there, and pre-made the different indicators that we like. So let's go to the straight shots chart pack, and I think this one is the best one to use for analysis of just a particular index and looking at the indicators across the board for it. So let's go ahead and we'll look at let's look at the S&P 500, because I think everybody's mostly interested in that. All righty, and here's what's included in the straight shots S&P 500 chart list. These are all of the different charts that are within that. And as you can see, we can go down. Not only do we get the different time frames already done for us, we have the Swenland trading oscillators in there. And we can just arrow through and look at the various indicators for the S&P 500 only. Now we have the volatility index, we have the big picture indicators, which ones are above their stocks are above their 250 and 20-day EMAs. Over the short term, that works out very well. And over the intermediate term, you want to look at the 50-day, and the stocks above the 200-day is really your long-term look at what's going on big picture wise. Well, we're certainly seeing on the rally that we had off of the low here that we are getting some participation in the shorter term, and I do like to see that. We're still only just a little over half of the S&P 500 above their 20-day EMAs. That's not a lot. We certainly want to see some improvement there, at least up into that 80 range, where you can see is typically the top of that range. We also need to see some more action here as far as stocks above their 50-day EMA. So in the intermediate term, we're still looking at very bearish readings here with not a lot of participation. And certainly in the longer term, some problems as well, with less than half of the S&P 500 above their 200-day EMA. So you can just go right through here and get to all of these big picture indicators, just arrowing through these chart packs. So here's the, let's see, here are the percent PML rising, crossover buy signals, and those above zero in the S&P 500. And again, this is your big picture type indicator. We're getting a short-term, we get the short-term look with PMOs rising. So when your PMO is pointed upward and of course going that direction, doesn't matter where it's located, just as long as it's rising, that is a short-term look. And we're having some nice improvement there. I like seeing that move very quickly up into that 80 range. I think that is very encouraging given the the concerns of what's going on with the market right now. I think that's a good sign, seeing all of those PMOs rising. That means momentum is positive for 82% of the S&P 500. And looking at crossover buy signals, how many of them have crossed over and have a buy signal? A little over 50%. We need to see more participation there in the intermediate term. But it is, again, encouraging when you start seeing these moves. Long term, not much improvement. We're looking at only about a quarter of the S&P 500 that have PMOs above the zero line. So in the case of right here, the S&P 500 itself, it is not above the zero line. It's currently trying to give us a buy signal here, and it is rising. So right now it would fit within this category of rising and crossover buy signals, but it wouldn't fit here because the PMO obviously is well below the zero line. So when you have a very strong market and a lot of momentum, and you're looking for the condition of the market, that's where you'd want to go. All right, I'm going to just pick one more, and then we will move on and do our takeaways from today. So I did want to show you that we have the S&P 600, and we have plenty of indicators as well. The STOs, the short-term, the Swenlin trading oscillators, and the ITBM, ITVM are our premier indicators, I suppose, the ones that you use, the greatest hits. Like, you should use those every day when you're looking at these different indexes. Those are the ones you want to definitely look at. And then we also, of course, have breadth indicators in here, and the McClellan oscillator as well, and that's for the S&P 600. So you can see lots of choices. We even have the S&P equal weight ETF. And again, you're going to get all of that same information, the STOs, the ITBM, and the ITVM. So trend and condition analysis basically is looking at not only the price trends, but you want to also look at what the conditions of the market are. And the best and easiest way to do that is to use those DecisionPoint ChartPacks. That gives you the easy way to get to those primary decision point indicators, and it also gives you that opportunity to see all of the other big picture indicators you might want to look at as well. So let's go ahead, and I want to go through our takeaways for today, and then we'll look very quickly at our poll. All right, so takeaways for today. What you want to look at first is your priced trend analysis, and that's where I get my trend model signals. I didn't go through exactly how we calculate them, but they are based on 5, 20, 50, and 200-day EMA crossovers. You can find tons of information on this in Chart School. I will probably do a workshop just really concentrating on our trend model in the future. But for now, that's the best place to go, is Chart School. And of course, if you read any of our articles, whenever we have a signal change, I explain why we have the signal change and how it comes about. Condition analysis, you want to look at your PMO signals, volume. That's for your individual stock, equity, or even index. But then if you're looking at an index, now you want to look at those big picture indicators. And again, the trend and condition and straight shots ChartPacks make this super, super easy because they're already there, and you just pick your index and then boom, everything is in there that you need. And like I said, you would be surprised how many different VIXs that we have. You would be surprised at how, volatility indexes. You'd be surprised at the Swenlin trading oscillators and ITBM, ITVM that we have it, not just for the S&P 500, not just for the NASDAQ 100, Dow, S&P 100. We have them for almost all of the major indexes. And if you remember, we even include some of the equal weight indexes. So really great information. I hope that you will go and at least try downloading one of the ChartPacks and maybe just noodling around with it. So I think that it's a great place to go and a great way to do your analysis. And of course, decision point analysis, it is simply those chart packs are made so that you can do that kind of analysis. All right, so that's all I have for the trend and condition analysis workshop. If we can, let's bring up the poll and see what has been going on there. All right, and I really did think that this would be the answer, that about 2/3 of you have not even downloaded one. Well, that's understandable because you do need to be an extra member above, so that kind of cuts that down a little bit. And the reason why is basic members get one chart list, and as you could see, those chart packs have hundreds of chart lists, so you do need to be an extra member or above. The market indicators chart pack, that's the one I showed to you 2 weeks ago, so glad to see 1/3 of you have gotten involved with that one. The trend and condition, the straight shots, hopefully you'll reconsider those and maybe, again, noodle around in there and check them out. I'm guessing, Tom, that you haven't downloaded any, but that would make sense. You have your own process pretty much in line.
Yeah, I've downloaded ChartPacks. I haven't downloaded DecisionPoint, but I have downloaded, I think, Arthur Hill's ChartPack, because he has a lot of ETFs and so forth in there that were appealing to me rather than try and create those chart lists. But anyone that follows DecisionPoint, any of the models and so forth that you all use, I don't know why if you are an extra member above, I don't know why you wouldn't have downloaded, because it's a lot of information. It's going to save you a ton of time. And I really think that's what all of the chart packs at StockCharts are designed to do, really to save you a ton of time putting together these chart lists.
All right. So anyway, if you go into your account from the main page, that's where you're going to find how to load up those chart packs. And when you go in there and you click on a chart pack, it does give you the list of everything that's in that chart pack so that you have an idea of what you're getting ready to download. And so that's the best way to do it. I hope you do take a peek at these.
Great. Absolutely.
All right. 10 and 10.
It's time.
Yes, and obviously I've been talking, so I don't have an RRG, but I'm going to get all of those input in my 10 and 10 chart list, and we'll start going through them. But Tom, I'm going to let you just go ahead and take it away. Let's do this.
Yep, we don't have the RRG, but I have the R.
There you go.
Rider system. Yeah, I mean, this isn't a bear flag. I'm not excited about it. Stock's gone from $80 all the way down to 54, and that was over maybe 5-6 week period. I mean, that's a pretty steep drop. You're talking about 1/3 of the company's market value being lost in a very short period of time. I think maybe we had a little bit of a capitulatory bottom. I marked this heavy volume day. You can see more than 2 million shares had traded. We came up well off of that earlier low, even though we did continue down the next couple of days. That low essentially has marked a pretty important bottom down around $54 in the near term. So I would watch that closely. I don't like the pattern here. I do believe that if we can get a break above 58, we have a chance to run up, test that 20-day moving average. So that gives you a little bit of room back to the upside. But overall, clearly there's a lot of distribution that's been taking place in Rider. Just not a big fan here. So I don't like the chart. Again, maybe you get a little bit of a short-term bounce, but I don't think the selling necessarily is over just yet, or at least we need some time to consolidate and before the stock will be ready to move back higher again. So I think from the current price up to $60, $61, I'd actually be a seller.
All right. The most popular in the chat room is CLF.
All right, that is Cliff's Natural Resources. This was a very hot stock. Back in September, the stock ran, you can see, from 9.5 up to 13. Pretty good volume, but it ran almost all the way back down to 9.5. That's the beauty of the stock market. Just when you think you got a big runaway stock, it comes all the way back down. But it did hold that support level, so I think that's important. I also think it's important that we failed at the 20-day moving average. So for me, I would be looking at this as a stock that is currently range bound. I would use that 950 area. We could even move that up to the close right here. That was the lowest close. You can see that tail came right down to it. So let's call it 950, 960, pretty good area of support. And to the upside, that 20-day moving average, you can see we just tested it, went above it. This is what I don't like to see. I don't like these tails where it looks like we're making breakouts and then we fail. Look at what the stock's done today, down 3% on the heels of that reversal. And from the top yesterday, 1130, all the way down to the low today at 1050. I mean, we're talking about 7.25% drop in 24 hours. So you do need to pay attention to these short-term, if you're a trader anyway, these short-term warning signs that the market provides us. Here, I think the 20-day moving average is going to be critical. We're currently at 1097, and there's the low down around 950 or so. So pretty wide range, but that's where I would expect to see CLF trade in the near term. Further out, I think we break out. I think eventually we're going to make this move above the 20-day moving average, but I would continue to trade this trading range until we see it.
All right. Let's see. The next one I'm going to give you is Camping World Holdings, CWH.
All right, I'm going to stretch this chart out because I know that this used to be on my strong earnings chart list. It's probably been a few quarters. Might have been back in here when we had this big move. Maybe it was back in June. I'm not sure. But anyway, that to me looked like probably a character of change. Went up a little bit higher, failed though, and then we failed to hold on to that 20-day moving average and you can see all these tests trying to get through the 20. Finally got through, really didn't get much going to the upside, and then went down and set a new low, and now failing at the 20-day moving average again. So I think that this one is definitely trending lower. I'd have to see something technically to get me interested in the stock. But in the very near term, just the failure at the 20-day moving average. I also could draw a trend line or a support line coming across. That was the low back here in early October, right at about 19.5, 19.25, something like that. So not only are we trying to get through the 20-day, but we're also trying to negotiate that level. And we could probably put a couple more, connecting this low close back here in June. So I would say maybe 18.5 to 19.5 is a pretty key area. We got up to 1956 earlier. We reversed back down. I'm not a big fan. I would be on the sidelines just watching.
All right. How about Berkshire Hathaway?
All right. I'm assuming that's the B shares.
Oh, yes. BRK/B.
Yeah. I mean, I don't know about the other shares. I think if we pulled those up, I can't afford one. It would work a lot more years to afford one, but the BRK/B shares are a little bit more reasonable. They just came out with earnings. Berkshire came out with earnings, so you can see a nice positive reaction here. I think that there's an uptrend in play. This is a stock we could probably take a much longer term view. Most those who trade or who are invested in Berkshire Hathaway, I don't know, I'm making an assumption here, but I'm thinking mostly are long-term investors, because that's really what the company does, is it tries to invest in value and let that value kind of unlock over time. But I do like this uptrend move, and then the channel that was just broken this week. So let me just show you what I'm talking about here. When I see moves to the upside like this is a pretty steady move for about, 10, 12 weeks. And then we go into this period where we just move a little bit lower over the next few weeks. But you can see it's really almost like this channel that it was in, and now this week we're breaking out of the channel to the upside. So I fully expect we're going to make a breakout above 220, 225 and trade at new highs. The other thing I would suggest is when you look at this chart, notice that the weekly PPO remains above the center line almost exclusively. And that's a pretty good sign that a stock is continuing to remain in an uptrend. Currently, that weekly PPO turning back higher again. So I would expect another breakout here. I don't know, from a trading perspective, you might get a little cheaper, but from a longer term buy and hold, I think this breakout's a pretty good indication we're going to see higher prices.
Okay. Let's see. Every time I see this symbol, I think of the English Standard Version. ENSCO, ESV, Energy, Oil, Equipment, and Services.
All right. Another one I'm going to stretch out here a little bit. Yeah, I mean, we keep putting in these higher lows, which I like. These are more short-term lows. Here's an intermediate low coming down for 3 months. So no matter how you slice it, I think we have a stock that continues to trend higher, which I like. You got that double bottom down close to 6, so I would treat that as pretty important support. Talking about this right down here, you can see these two lows, but you have other lows as well. I think as long as you continue to hold this double bottom, though, I think it'd be hard to argue that you're not in an uptrend. So I would be looking at this as, a trading range close to 9.5 to the upside, all the way down around 6 to the downside. If you want to keep it a little tighter to the downside, you might just connect these lows, which are rising. So you got a nice little rising trend line here that I'm going to say would intersect pretty close to the low we had last week. So let's say around 660. So you could certainly keep a tighter stop if you wanted to the downside. There's no reason to go back down below these lows. But if you really want to go back, give it a little bit more room, the double bottom at 6 or just above 6 is where I would look.
All right. Let's see. The next one I'm going to give you is Star Surgical, STAA. And the RRG does not look good on it. So I'm curious what the chart says.
Well, I mean, it broke the down channel. It's got an overall trend higher. I would be okay with this one as long as it holds that rising 20-day moving average. And that's what I'm going to shorten because I don't really need all of that from earlier in the year. Let's just do the last 6 months. A little bit better look at the candles. But you had a stock that's been trending higher. So I'm fine with that. I think that that's a good thing. I'm waiting for a breakout if I've got an uptrending stock. Clearly the trend line right there, and I could drag this and have pretty much a channel coming down here. That broke with this gap up on heavy volume. I'm assuming that's earnings. We came back down, we filled the gap, and notice we're holding this 20-day moving average. So this is one that because we have the longer term uptrend in play, I'm going to assume that we're going to continue to trend higher. And now that we've broken back above the 20, we struggled with it for, well, throughout October. But now that we've broken back above it, I'm going to watch that to the side here. But my expectation is we're going to get another breakout above 45 and ultimately make a run back toward the high. I wouldn't be surprised off of this uptrend for this now to turn into like a cup and make a run back toward 53, 53.5.
All right. One that also has a very similar look to its RRG, Life Vantage Corp, Food Products, LFVN.
Yeah, I see the same kind of a pattern here. I mean, I think it's a nice uptrend in play. Here is looks like a rounded cup, really having a nice day today after gapping lower earlier. Only thing I see with this one is just the overall volume. I'm not a big fan of companies that don't have as much volume. Today, 126,000, but you can see that's a pretty good volume day already for the stock. Many of these days are going to be under 100,000 shares. So for me, that's the only downside is I just don't like to trade a stock that has a history of fairly light volume. But here was your high back in September. And I think if you come down here and put in this low, where we are right now, I think you can kind of see the formation of this cup taking place. So I think you got a really good chance here to make another run back toward that high, close to $13. We're sitting at $11.69 here. So that's what I would look for to the downside. Maybe watch that rising 20-day moving average with today's action on heavy volume. No reason really to go back down much below, say, 1050 to 1075.
Okay. Let's see. This one's been asked for a while, so I'm going to give it to you. Viking Therapeutics, VKTX.
Right. Well, you're battling price and gap support here. Huge move to the upside. I don't know if that's earnings or maybe something that they've announced, something approved by the FDA. I mean, who knows? But it does look like the selling perhaps is over with that low. And I say perhaps because it looks like maybe an inverse head and shoulder or bottoming head and shoulder trend line. And I would connect these highs right in here coming across as my neckline. So you move up, you come down, left shoulder, you bounce, left side of the neckline, you come down, put in a lower low, go back up and hit this prior high. Now, as you're trending lower, notice that each time we go down, we don't go back to the prior high. We just keep putting in lower lows and lower highs. The significance of a reverse head and shoulder or an inverse head and shoulder pattern is that you break that trend of lower lows and lower highs, and you actually go back up. And in this case, the high that we saw back on Friday of last week took out this prior high on an intraday basis. So you're beginning to see a little different character on the chart, so that when you start to pull back, I would actually be looking at this as an opportunity. Now, this is a stock that's moved from $4 to $24, back down to 12, recently up over 15. I mean, you can see the volatility. Make sure you're comfortable with this kind of volatility. But just looking at the chart, I think this pullback's an opportunity to the downside, 12 and a quarter. That area is one that I would watch pretty closely, maybe buy on the way down, especially if it's on light volume. But I'd ultimately be looking for this breakout just above the $15 level.
Okay, let's make a comparison. Here's another biotech, Illumina, ILMN.
Yeah, this is not a small company. This is a much bigger company.
Exactly.
And has been one of the better performers. I mean, if we go back, pull up a longer term, I'll come back to the daily chart. Look at the monthly chart. This was a stock that was down under $3 in 2004. Now it's $322. Pretty consistent. It goes through scary stretches. I mean, you look, oh, that's just a little bit of a pullback. Well, it was from $75 to $25. That's not a little pullback. Here, it looks like probably from, I don't know, $250 back down to $125 over the course of a year. So you've got to be able to, to be willing to take from a longer term standpoint, you got to be willing to take quite a bit of hit. You can see after a big run up the last couple of years, maybe we're just starting one of these periods where we underperform for a while. But the long-term chart, I think, remains very bullish on this stock. So what would get me interested on the daily chart? Well, we started lower. We bounced. We went to a new low. We didn't stop at the 20-day and put in a lower high. Instead, we went back up and put in an equal high. We could be putting in a bottoming head and shoulder pattern or maybe an inverse head and shoulder pattern. Either one of these, though, would be bullish if we get the breakout above the neckline. So that's the key for me right now is watching that neckline at around 330. If we can get a breakout above it, then I think most of the selling is behind us and look for a run back up toward that 370 level. If we fail at the 20-day, begins moving lower, you got this left shoulder, and then finally this low here, which coincides, by the way, with that July low. So I would have to say you got major support down at 270, major resistance right now at 330. Let's see which way breaks first.
All right. And let's finish off with Groupon. I can see that since I quit using it back in December, they've just had a really bad time. I just couldn't support them anymore. So
yeah, well, I guess you have the same impact on Groupon I have on Starbucks.
Exactly.
Similar anyway. Yeah, that's why Starbucks is breaking out right now, by the way. I bought 2 lattes the other day. Somebody got word of it. Yeah, Groupon's just been trending lower for quite some time now. I mean, I think it's pretty clear when you look at it. Notice that you don't see equal highs here. You see lower highs. And if you connect this to the bottoms, you also have lower lows. So we are in this channel right now on Groupon. I see no reason at this point to get excited. Last move to the upside, volume wasn't that great. PPO did react. So maybe if we go back down, put in a low, maybe we'll get a positive divergence and a little bit more buying back to the upside after that occurs. But for now, I would avoid it. I don't like the chart. I think that we're in a clear downtrend, and until that changes, I would be on the sidelines and I would avoid Groupon.
All right, that's it. That concludes the 10 and 10. Here are the symbols that we just went over. And you will find all of these charts as annotated in the Market Watchers Live chart list. All you have to do is go to the blogs page, click on the Market Watchers Live blog, and you will find the link at the very top of the blog page. It's also in all of the recaps as well. All right, time for our final market update. Let us see what is going on. And I did see something very interesting I'm looking forward to showing you. All right. Okay, so currently, as you can see with the markets, the Dow, the S&P, we hit those lows on Friday, and we've been really steadily moving up from those. And right now, the Dow is up a little over 0.5%. S&P 500 is up about the same, a little over 0.5%, currently at 2752.78. NASDAQ is higher on the day. Currently, it's up 0.7%, 51 points. OEX, S&P 100, seems to have hit the intraday high and is getting stuck there. We'll have to see if it can beat that morning intraday high soon. Currently, the S&P 100 is down I'm sorry, up about 0.5% as well as the others. S&P 400 and the Russell 2000 also making moves to the upside, currently at intraday highs or very near so. Mid caps are up a little over $10, $10.50, $10.80. The Russell 2000 is also up right now, and again, sitting near intraday highs at about 1557.33. TSX, Canadian markets are also up today, up a little over 45 points. TNX, Treasury yields are rising and have been rising since this morning, although they were lower. Currently reading 3.214%. Big move. This is what I found very interesting. UUP, the dollar is down about 0.13%, as you can see. It seems to be consolidating sideways right now, and I think we're going to see it finish it on the negative side. But also, typically when the dollar moves down, we usually see gold rise because the price is, is based on the dollar. So it usually is a reverse correlation. But look at what's going on today. Gold opened slightly higher, but has been declining steadily. It's finally finding some support, it looks like, right near that 115.80 mark, it looks like. So we're seeing the problem with this is that when you see gold falling like this, when the dollar is down, that tells you that there's an excess of sellers. And so that is not what you want to see for gold. It also is broken down below those lows that we saw yesterday. TLT is mostly unchanged, and USO oil is continuing to slide lower, forming what could be a little bit of a reverse flag here. So we might not be done with the decline. But when I looked at that daily chart, and remember we looked at it in the workshop as well, $13 is a really strong area of support. It should hold, but we'll have to see what happens by the end of the day. But it did seem to put on the brakes on its decline when it hit the $13 level. That's all I have for my portion of the final market update. What do you got for us, Tom?
Yeah, I just want to point out, this is a chart that I like to show a lot, just U.S. rates, 10-year Treasury yield versus Germany's, and it continues to rise. And with the 10-year Treasury yield moving back up, getting close to that 3.25%, I just want to show you that the difference between the yields here in the U.S. versus Germany really taking off to the upside. And that is a suggestion that our economy here is much stronger than what we're seeing in Germany, and that normally coincides with a very strong dollar. When we've come through periods where we've had that inverse relationship, when the dollar's been going down, even though our rates have been going up faster than Germany's, normally we come out of these periods with the dollar rising very rapidly, and I think that's what's going on right now. I think the dollar is going to continue to move higher. We have, looking at this 10-year chart showing correlation, it stays mostly in positive territory, meaning that when U.S. rates are going up faster than Germany, we tend to see the dollar rising, which makes sense. For me anyway, that's it makes good common sense. So anytime the market's doing something that makes good sense, I tend to follow it. I think the dollar is going to continue to rise. Now, one thing that it's beginning to have an impact on, even though today we're down on a relative basis, small caps. Small caps have held on to a key area of relative support versus the S&P 500, and we are starting to see movement back to the upside. When the dollar is rising, as we've seen in the past, that normally sends money rotating into small caps. Something to keep an eye on here as we head into year end. Okay, we're going to move on to sector rotation. And what I want to do first in starting this area of the show is just first talk about the S&P 500, because to me, sector rotation is the stuff that takes place under the surface of the market. When you turn on CNBC, they don't normally say, well, aggressive areas are doing this, defensive areas are doing this. They tell you what the Dow Jones is doing, what the S&P is doing. And if it's doing great, there's a lot of, hand clapping, partying going on. And if it's not, then you get all the fear. But for me, it's also about evaluating what's taking place under the surface of the market. So you got two things. Number one, what's price action doing? And then number two, where is the money rotating in the market? So I want to start first with just looking at the price action. Now, the S&P 500 gapped down back toward the end of October from 2755 and change. Gap down, came back up, went above 2750, continued moving lower. This is where we had the panic sell-off all the way down to 2600. 2 weeks ago or a week and a half ago, when we came back up above 27, actually it was at the end of last week, came back up above 2750 again. We got to 2756 and change, literally right to the penny almost of this gap resistance. Pulled back, went to the top of this gap, which we saw at the end of November, or excuse me, end of October. And now we're rallying again back up near this 2755, 2756 area. When I talked about overhead resistance here in the last couple of weeks, I've been talking about this 2760 area. I think this is a pretty key area of resistance for the bears to defend. And I'll show you, going back to some earlier periods in 2018, why I think it's important. But this is the first level that I think we need to watch. And the S&P is trying to get back through it again. Very important to watch this, I think, into the close today. And then maybe as we go forward here over the next few days, because if we can get the break there, I think it adds to the bullishness that we already saw at the end of October on this break of the trend line. So that was the first step, break the downtrend. Second step is to sideways consolidate and begin to take some key areas of resistance out, price resistance. And I think that 2755, 2756 area is very big. So let's see if we can do that. Now I want to move on to another chart. And on this chart, this is the long-term chart. I'm going to come back to some hourly charts in a minute. But here is a long-term chart showing you that we're still in a bull market. I mean, we can talk all we want about bear market, or we think it might be a bear market, but we've had a lot of these scares over the last 10 years, and the overall channel remains intact. In fact, moving back down to test the February low would simply be testing the bottom of the trend line as well. So I don't really start thinking bear market unless we lose those February lows. I think in the meantime, we're consolidating, correcting, whatever you want to call it. But I don't believe that this is the start of a bear market. Price action will tell me that, certainly if we lose the February low. Let's move on. Let's go back to that 1 hour chart. And I want to show you, okay, this is where we are right now. And I want to show you the defensive groups relative to the S&P 500. Here is real estate continuing its uptrend. So even though we've broken the downtrend on the S&P and we're going sideways here, we still have a relative uptrend in a key defensive group, real estate. The XLU versus the S&P broke down. That's a good thing for the bulls. We got one behind us. But you can see the XLP relative to the XLY. This is the consumer staples versus consumer discretionary. Still in an uptrend. So two of these three ratios are still trending higher. So if we can't negotiate this overhead resistance and begin to roll over, this is not a good sign, because technicians are still going to be looking at these areas as ways to make money, at least on a relative basis. Now let's go down memory lane. We're going to go back to June of 2018 and take a look at what was going on there, looking at basically the same chart. Let's see if I can get this to come up. Here we go. All right, so back in June, here was the latter half of June. See how we had this downtrend on the S&P 500? And see how the XLRE versus the S&P 500 was trending higher? Utilities relative to the S&P trending higher, and the XLP versus the XLY trending higher. They all broke down second week of July, just as we made this breakout above the trend line. So this is kind of the first step. You want to get price breakouts. Second step, you want to see money rotate away from the defensive areas. Let's go on to the earlier time back in February, March, even into April. Now, I will say that the first drop that we had back in February, money really didn't rotate on a relative basis toward anything. Everything was going down pretty substantially. Maybe saw a little bit of rotation into real estate, a little bit into utilities. XLP didn't get any of the money, very little love on a relative basis. But the next move down, as you can see in March, once we got a little bit of a bounce, that's when everyone started getting more defensive. Real estate on a relative basis began moving. Same thing with utilities. Not quite as much, but a little bit with the XLP, XLY. But that broke back in the second week of April. We saw a little push to the upside. Notice the S&P, though, came back down, failed to hold that 20-period moving average, 20-hour moving average, and we started another downtrend. And here was the relative strength, again, on the defensive areas, at least utilities and real estate, both moving higher until we got a breakout and a breakout above. This was a pretty key area of resistance, I would say, on the S&P 500 around 2680, 2685, triple top. We made that breakout. And after we made that breakout, you can see the breakdown in what was going on underneath the surface in terms of those defensive groups. All right. So those are some of the things that I want to see now. I want to see not only us break out above that 2760 area on the S&P, but I want to see these relative, the relative strength charts break down on the key defensive areas of the market. All right, so let's take a look at the aggressive stocks. I want to pull up the XLK, and I'm going to do this relative to the S&P 500. And instead of a daily chart, I'm going to go weekly. You don't need a candlestick. We can do this with a line chart. And let's go back throughout this bull market, 10 years. Now, a lot of folks are ready to write the market off, but I am still looking at the XLK relative to the S&P. Yeah, we're getting a little bit of a pullback, but that normally happens when the market sells off. Normally, we get that pullback. Late fourth quarter, 2017, when we started to see all that selling in January and February, you can see we had pulled back quite a bit from that prior high. Back in 2015, 2016, a lot of sideways action here. You can see here we had a very significant pullback 2012, 2013, but we didn't go below prior lows. Here, I think we still have a nice uptrend in play. I would maybe begin to get nervous, a little bit more nervous if we were to break the low we saw back in March, April, that relative strength. But for now, I'm seeing still money on a longer term basis rotating towards technology. And if we take a look at the XLY versus the S&P 500, so consumer discretionary, up move, sideways consolidation, breakout, sideways consolidation, breakout. I'm not seeing anything horrible in terms of relative strength. Yes, short term, last 3 months or so has not been good, especially October. October was very weak, a lot of the aggressive areas, and especially I think if we pull up the XLC, you will see some relative weakness. But again, if you step back and take a look at the longer term picture, I think what we're seeing is higher highs, higher relative lows, and it's okay for the market to pull back and consolidate and base for a while. That actually is much healthier than just going up every day and, you know, getting into some sort of a parabolic. Here you can see communication services relative to the S&P hit a high back in July, pulled back, but that prior low has not been violated. And we are seeing just relative, we're just kind of going along for the ride here over the past month or two in the internet area, the communication services, those types of stocks. So when I look again at the aggressive areas, what's taking place from a longer term perspective, the S&P 500 still being in that long-term channel to the upside, I think it's way premature to look at short-term weakness in certain areas and say this is the start of a bear market. You know, yes, the price weakness is not good, especially when we get the volatility index doing what it does. But I do think that, in fact, I think that might be, I may have a chart on that volatility index. I think it was on the weekly chart. Yeah, here it is. So here's your VIX. And, you know, maybe just go back and stress two things that generally happen. Well, two things that have happened during the last two bear markets and will generally happen in any bear market is the bear market from 2000 to 2002. Notice where the weekly PPO was. It stayed below the center line. A negative PPO is required to have a bear market because you have to have a downtrend. And if you have a downtrend, your short-term moving average is going to be below your long-term moving average. Anytime we have a pullback in an uptrend, notice the PPO, weekly PPO, is still positive. So one of the things for the bears this has to go negative. You can't have a bear market without a negative PPO, weekly PPO. So, and just because you go negative doesn't mean you have a bear market. But if you're going to have a bear market, you must have a PPO in negative territory. All right, so we're still in an uptrend here, but look at the VIX. During the last two bear markets, as we pulled back, we had bounces, pretty significant bounces. But when we had those bounces, notice the VIX never went below 16, 17. Same thing, 2007 through 2009. Never went below 16, 17. So in this market, if we do see another pullback or another advance back up near the highs, we shouldn't see the VIX go down much below 16, 17. I would watch that. VIX right now is back below 20. A lot of times during uptrends, during bull markets, we do see the VIX surge up into the mid 20s to 30, even occasionally above 30. And that normally establishes a pretty significant bottom. So I think there's a lot going on here that we want to continue to watch. Now, on an absolute basis, yes, we have some issues. The XLK, we need to get through the 20-day moving average. The XLY already has, but it needs to hold above the 20-day moving average. The XLC, we need to get back through the 20-day moving average. A couple of key industry groups, software, trying to get through the 20-day moving average. We need to see this. Financial administration stocks, PayPal, Square, those types of companies had been leaders, struggling to get through the 20-day. So short term, we have issues. Longer term, I'm still in the bullish camp. So let's pull up a summary, some of the things we just talked about here, and then we will wrap up the show. But yes, short term, the sector rotation is definitely worrisome, but only when I get concerned is when the defensive groups lead our rallies, not when they lead to downside moves, because money just naturally rotates away from aggressive areas to defensive areas when the market pulls back. Always has, always will. But when we start rallying and our last feeble attempts to the upside are accompanied by relative strength in real estate, utilities, consumer staples, that's when I'm going to be very concerned about the market. But anyway. All right, Erin, time to wrap up.
Indeed. Yeah, I'm looking at the same sort of information you are as far as sector rotation. And I agree that, it usually moves into those defensive areas. I don't know. I just feel like we're seeing more activity that direction that has me a bit more worried than the last time we corrected. But, hey, my analysis is similar to Carl's, and like I said, he's pretty much on track. He thinks this is it, bear market time. So I'm not quite there yet, but I certainly see his point.
Yeah, and hey, stock market's made up of two sides. Everybody's got to pick which side they're on, and I have no problems with anyone taking a different approach and a different opinion. I mean, I certainly have been wrong plenty of times in the past. It's going to happen.
Me too.
Yeah. Yeah, we get humbled just about every Monday when we have to do these setups.
Absolutely. I would say so.
Yeah, but anyhow, I am looking at the market right now. It is trying. I mean, it's having a pretty good day. We got the Dow up 120 points right now, but it is rolling over. The S&P, which got up right close to that 27, I think that's 2754 today, now back down to 2750. Let's see if it's got some oomph into the last few hours of the day and whether we can break out. But I mean, there are some good things taking place in the market, but I want to see some of those leaders begin to take out some key levels, and that's been a struggle.
Yep, absolutely. Wow.
Yeah, another day. We did mention earlier in the show, though, it is election day, so everybody make sure, at least those of you in the U.S., make sure you get out and cast your vote today. I tell you what, I'm going to cast my vote for Brian Livingston and Grayson Rose coming up next couple of days. That's going to be awesome to have them in on the show with us. And, of course, Mary Ellen will join us again on Friday for What's Hot, What's Not. Okay, it is a wrap. I want to thank all of you for stopping by today and hanging out with us. Please remember to complete the survey as you exit. We do love to get your feedback. Always want to hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Get out there and vote, and we will see you back here tomorrow. Happy trading.